We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Gareth Soloway, President and Chief Market Strategist of InTheMoneyStocks.com. How are you today, Gareth?
I'm doing great, Tom. How are you?
Excellent. And we're speaking here on the morning of Tuesday, the 20th of December. And it seems like, before we hit record here, it just seems so crazy that Japan moving their 10-year rate up 0.25% has had such dramatic implications for the currency and especially the metals markets. Obviously, that's what matters a lot to us. So, maybe obviously we can start there. Why do you think that had such a dramatic effect in the metals and currency markets?
I think the biggest issue here is, and the reason why it was such a big impact is because it's the first sign that Japan is actually willing to budge on this policy of theirs, where they've been at basically zero interest rates for so long. So I think it's not the 25 basis points that's really the shock. It's that they actually moved at all, which seems crazy, but they've been in this kind of policy of no interest rates at all for such a long time. And now it looks like it's starting to change.
Yeah. And, when we see, let's say the Japanese yen move down so significantly, and considering that it makes up such a big part of the DXY, why is the dollar down as well? You would think that the dollar should be up on something like that.
Yeah, the only, and you're right about that. The only thing I can think about is that, does this signal some bigger trend of a slower macro economy, right? So if Japan is moving because they're seeing certain things, not only inflationary, that are causing them to make this move, does it speak to a larger trend of large economies beginning to weaken? And does that eventually mean that the US dollar will fall because stimulus may have to come back at somewhere in the future? I mean, is that the end goal? And how many years out? Who knows? But you're right. It is interesting to see the dollar fall.
Mm-hmm. Is this basically Japan really acknowledging that they need to start fighting inflation? And, as you say, is this a larger trend for these bigger economies to have to really take inflation seriously?
I think it is. I think the biggest kind of switch that I saw is this, if you go back on monetary policy, whether it was the Federal Reserve or Bank of Japan or Bank of England, I mean, there was this kind of pressure cooker where they always wanted to keep asset markets up because they felt that wealth effect was working. And then what we saw is over the last 10 years, the rich got richer and the poor didn't really benefit as much. If you didn't have investments, you didn't make much money. Wages were stagnant, all that. Now, all of a sudden, what we've seen is this kind of rotation of thought process where they're saying, okay, we have to start paying attention to inflation because that's what the poor and middle income people are really being affected by. I mean, they're getting poorer because prices are going up. They can't afford that. So you have to kind of look at it like, okay, so forget about the people that have money already. How do we start dealing with the poor in the world?
Mm-hmm. So Gareth, you also said that we might see the Fed or central governments, central banks in general, come back in and stimulate again. So do you think that we end up getting another wave of inflation once we see that?
I do think it's going to be a tough battle to fight. And I think we have to look at how the trend has been, right? So we've been under trend of inflation for many, many years, which then usually means to get back to the medium or the mean, we have to have a multiple period of years above that goal of 2%. And I think that's what we're going to see. But having said that, that would generally indicate the Fed would be unlikely to stimulate. I would argue that in the beginning for the next few years, the Fed will be really hesitant to print any money or lower interest rates because inflation is going to be sticky north of 2%, whether it's 3, whether it's 4, I'm not sure, but they're going to be not wanting to trigger the inflation bug again. However, let's say 5 years out, we find ourselves in this long recession that's borderline depression. There will be a point where it gets so bad, they will have to go back to what they do best, which is printing money to stimulate growth.
Mm-hmm. So, sticking with the idea of the Fed, do you think that they've already gone too far, and why is that?
I do think they've gone a little far. And again, part of it, I think, is human psychology. The Fed, when it comes down to it, everyone looks at the Fed and says, oh, they're almost superhuman. They're these great, bankers and everything. But in reality, they're humans and they have emotion. And I think they got way off sides on the transitory call. They feel like they have egg on their face from that call. And I think they kind of overreacted and said, oh my goodness, we were wrong. Now we have to prove that we're tough on inflation. And they've gone a little too hard, too fast in the opposite direction. So my guess is that we haven't seen the recession yet hit, but it is going to come in a big wave. And it's going to be nasty. It's going to be one of the worst recessions that we've seen probably since 2008, 2009. And it's likely going to last a lot longer, mainly because the Fed won't be able to stimulate us out of it in the early portion. So, I mean, really, I've gone on record and said, I don't think the S&P will make new highs for 10 to 15 years. I still think that's very logical. If you look back at the dot-com bubble, it took the Nasdaq 15 years to make new highs. And here we are seeing the amount of liquidity that was in the markets, the bubbles in crypto, in stocks like AMC and GameStop. It's very, very similar. And without the Fed stimulus, we could be looking at 10 to 15 years before new highs are hit.
Mm-hmm. As we think about those highs that have been made, we saw the dollar kind of top out at around 115 earlier this year. And obviously now we're 103, 104. Do you see that, that theme also being kind of played out in the dollar, having that top made earlier this year?
Yeah, so I do think, honestly, I'm in a camp where I think the dollar has probably made a longer term high pivot. In fact, let's take a look at the charts here and kind of get a gauge on that. So what we do is if we look at this chart on the US dollar, the DXY, we can clearly see that you were trending up. And interestingly enough, if you can connect these highs and look at that, I mean, basically the high was right into that level. And I love trend line analysis because what you can get from trend lines is that every time it hits, you get some sort of pullback. And in this case, it's been a much bigger pullback. Oftentimes when you get this kind of triple-headed monster right here, that's the sign of a bigger top forming versus what we had over here, which was just an up move, pullback, and then new highs, obviously. So to me, I look at it and I say the Fed is now stepping down on their rate hikes. We just had a 50. It's likely we'll get a 25. As the economy weakens, we're going to get less and less hikes and probably even just more of a neutral policy, meaning no more hikes. And I think that really makes the dollar a tough sell for, or a tough situation to make new highs in the near term. So I'm in the camp anyways that I do think we likely will see the markets, or at least the dollar, having topped out here. And that's going to be very good for metals like gold and silver. I think it'll be phenomenal, in fact, for gold and silver.
So I'd like to stick with the currencies before we move to couple other markets here. Do you think we get more downside for the Japanese yen as well, Gareth?
Yeah, let's take a look at the US dollar yen, and because I think that's an amazing chart here. And the first thing that strikes me is this is the big move on the back of what the Japanese central bank did. I mean, that is a huge down candle. One of the things that strikes me, though, look at this. Take a trend line right here, draw it across. Notice how it hits this low, and then we draw it straight across and look at what you're into. So believe it or not, it's very possible that we get a short-term bounce on the dollar yen, but I am in agreement that I think that this change in policy for Japan is a policy that, again, if you follow it out months and years, is probably one where the yen starts to strengthen versus the dollar. And that's where you get this dollar yen chart to continue down in the longer term.
Mm-hmm. And just to kind of, I guess, contrast what we saw with the dollar versus the yen today, both of them being down on the day so far. How does the euro play into that as well? Does the falling yen give the euro any short-term strength here?
Yeah, it certainly looks like it's giving it a little bit of short-term strength. I mean, it's not a big move up today, but what we can see is that the euro has really had a very significant rally ever since we got down to that parity or just below parity between the dollar and the euro. It's been really all gangbusters to the upside. Now, I do think, again, the euro is getting towards resistance, right? We look at some trend lines in this area here. If I throw that one in there, and again, it's not wanting, there we go. So again, you might have a little bit more upside on it. And then, by the way, this is the FXE chart, which is the ETF that tracks the euro. But I think you have a little bit more upside. And then I do think, again, same thing. If the let's say in the short term, if the yen pulls back against the dollar, then you could be looking at just a little bit more, upside in the euro, if you will. So I think, again, likely to see the dollar weaken continuing over the next 6 to 12 months. And I think the yen and the euro could easily strengthen.
Mm-hmm. So, Gareth, we talked about this recession that's kind of coming. Is that going to be worldwide, do you think? Or is it going to be more focused in the US, considering that we've had so much stimulus over the past, let's say 12, 14 years, we've had such low interest rates. Do you think that this is going to be, a worldwide, like I said, recession that takes this extended period of time to be able to kind of cleanse the markets from all of this easy monetary policy that has pervaded over the last, decade and a half?
Yeah, and I'm kind of in that camp. And I think there will be areas of the world that don't get hit as badly. I think some of the emerging markets, whether it's China or South America, they could hold up a little bit better. Their economies, you could argue by looking at their charts of their main indices, they've actually been consolidating now for 14 years. You haven't had new all-time highs. I mean, speaking of what I just said about the US markets maybe not making highs for 10 to 15 years, those markets haven't made new all-time highs in 14 years. And so I think there's certain pockets where money will rotate out of the US, but I think the US is now on a downturn that will last a very long time. It will likely spread to the European Union, the UK, and maybe even Japan to some extent, although depending on their policies, maybe not. But ultimately, I do think that it's going to be something that is mostly global between the big powers.
And, you mentioned earlier that when we see the Fed come in and try to react to that, are we going to see, further downside in the dollar as the Fed really, we talk about the marginal utility of debt and printing dollars, and we know the effect that had. So do we see a real, or do you think we see more, dramatic downside for these currencies as they're basically printed into oblivion?
Yeah, I definitely think in terms of the dollar, I mean, that's where the ultimate outcome is, right? So you have a couple negatives working against the dollar. Number one is the Fed is now going to more of a no raise policy. So we know when the Fed was raising rates, it was strengthening the dollar massively. As soon as they kind of toned it down a little bit, we saw the dollar pull back. Now, eventually they'll print money, but that's going to be years away, right? They're going to hold out as long as they can until the economy demands it because it's in such bad shape. But I think the other factors we have to remember with the dollar is that you also have other countries starting to look to take over that reserve currency as well. Mm-hmm. And if the reserve currency starts to be, let's say in digital yuan or something else, there's a whole lot of dollars that countries around the globe hold, and we're talking trillions of dollars that they can then dump on the open market, which will also add to that negativity or downward move on the US dollar. So I do think that, again, the dollar eventually is dethroned. It's one of the reasons why eventually I do think crypto, or at least Bitcoin, becomes intriguing as a store of safety, at least a digital gold, to kind of offset the dollar decline. But yeah, I mean, it's going to be, the next 5 to 10 years is going to be unbelievably fascinating and kind of scary, frankly.
Mm-hmm. Does that idea of countries dumping trillions of dollars worth of reserves onto the open market, does that in some ways become a race for these countries to basically get the most value out of the dollars that they hold?
I think so. I think you're just starting to see little inklings of that. We've heard about China, buying oil in digital yuan now, and various other countries starting to speak up about how the US dollar shouldn't have the power that it does over other countries. So I think that that's beginning. I don't think it's going to be a rush to the exit just yet. Usually, just like stock markets and other things, the crashes occur at the end of the move when everyone finally realizes that it's in trouble. So I think for the next few years, it's going to be a slower decline with bounces, but it will get faster and faster towards the end. And I think if you're in the US like I am, I have to be very aware of how I diversify away from dollars.
Mm-hmm. Yeah, that's a great point. So we were talking about the S&P and some of these broad indices not making a new high for at least a decade here. So do we see dramatic downside, coming in 2023? What do you think the markets look like for this coming year?
Yeah, so I'm in that camp where I do think we see some pretty dramatic downside in 2023. So just showing my SPY chart, one of the coolest things, again, talking about trend lines here, this is the all-time high on the S&P. Here's the first hit of that line. Then you hit it here, here, and you gapped above it when we got that CPI number last week, and then we sold off. And what I love about that is it's such a negative signal. When a chart opens above a technical resistance point, it has every chance to break out. And if it doesn't, that's like a double negative. That's about as bad as you can get. And we saw that reversal on the back of that CPI number. We then had the Federal Reserve the next day, and obviously the continued sell-off that we're seeing here. So that was the negative aspect here, where I think short term, this has to be looked at as a major top. The next step is to say, okay, well, what happens in 2023? So you have to start thinking that we will see an official recession on the books. How does that affect earnings growth if the consumer really starts pulling back? I don't think that stocks have factored in the lower earnings growth or the negative earnings growth that they could see. And then you have to start to say, okay, well, if the Fed is not going to bail us out from a recession, how bad could the markets take that? And in the very least, I would not be shocked to see this long-term trend line here going back to 2016. And you could even extend this. I mean, this is what's amazing about it. We could extend this back to basically 2009. And that's kind of my target for 2023. So we're looking at about 800 points on the S&P to the downside, or maybe just a little bit less, 75, 80 points. In this case of the SPY, which I'm looking at, that's about 74, 75 points. But it's a big percentage move. I mean, you're talking, 20% probably at least.
So Gareth, I know, the SPY makes up a good portion and a good, selection from the economy. Do you see more volatility for something like the Nasdaq, just considering the tech heavy nature of it?
I do. I think the Nasdaq, just as it always is more volatile. We've seen it obviously down more percentage wise than the S&P 500 this year. And I think you have to look at stocks like Apple, which to me, and again, maybe I'm dating myself here, but if you go back 10, 15, 20 years, I mean, a quality name like Apple that has the growth, which is very slow growth, a couple of percentage points of growth a year, those stocks used to trade at a 10 PE. That was normal. That was proper valuation. And you still have Apple trading at a 20, 25 PE ratio. So for me, knowing how big Apple is, the market cap of Apple, if it were to adjust in a really bad bear market to, let's say, a 10 PE, you're looking at significant downside in the NASDAQ, because it means it basically has such a huge weighting in the NASDAQ.
And with all the bombshells that we saw in crypto this year, do you think we see a more favorable situation develop in this coming year for a bottom, or does regulation start to either hamper or help that situation?
Yeah, so I do, and I'm a huge fan, and I've been a huge fan since basically the all-time highs of saying we need regulation in the space. More so just because you need transparency. I'm an investor, so I want, there's idealists who don't want any sort of, involvement with the government in crypto. I understand that, but at the same time, if you want crypto to go up, and if you want Bitcoin to hit 100,000, 200, 250, 500, you have to have big money in there. And FTX ruined it. You could argue that Terra Luna, Celsius, Voyager, they were on that same path. But big money is not coming close in a million years to crypto again until there's transparency, until you have legitimate audit. You want the big four auditing firms to do audits. Then you'll start seeing some realization that money can flow in there. So I think that's going to be one of the key things that actually puts a bottom in for crypto. I do have it priced in. I still think Bitcoin goes lower. 9,000-ish is what I'm looking at right now. I think that is achieved by May or June of 2023. And then I think you're going to start to see a flip. With regulation, people and investors, and this will even be myself, if I'm looking at stocks and I'm saying, okay, these companies are going to earn less and less because we're in this long recession and the consumer's not spending as much. Well, where do I put my money? Well, now Bitcoin starts to look attractive. You got the transparency. It's become the digital gold. Maybe that's where I put some of my money. And I think a lot of other big firms will go that route.
So I remember at one point in 2022, you told me that your pick for this year was gold, versus, let's say, the dollar or the broad indices. So what is your pick for 2023?
So this is kind of, it's getting a little trickier. Last year it was a no-brainer, right? Because Bitcoin was trading, way too high. The S&P was still near, basically at all-time highs. So that was the easy pick last year for gold. This year it's going to be gold again, but it's getting a little trickier because I do think Bitcoin bottoms this year and has a bounce. I just think that it won't have a significant enough bounce this year to overtake the gains in gold. And I still have it priced in like gold should blow through its 2020 and 2022 highs of around 2070s to 80 this year. So we're looking at some major upside. I think 2,300 is a pretty solid target price on gold for this year. And again, the beauty of it is history is a great telltale repeater. And if you go to that mid to late 70s period, the chart is almost identical to what we're seeing in gold right now. You had this kind of mid 70s sideways to down chop like we've seen for the last 2 years in gold. And then you had the big breakout. It actually came in kind of the late 70s and gold 10x'd. So I don't think gold 10x's this time because obviously Bitcoin will take some money away from that. But I do think it's going to be probably, in the next few years, you could be looking at a 3x on gold.
So, what do you think are the drivers for gold hitting new all-time highs in 2023? Is it mostly the volatile situation that we're seeing in currencies and this this return, let's say, of flight to safety?
Yeah, so I think it's part of that, right? It's there's a couple things. So it's the fact that the Nasdaq, the S&P stocks, the stock market in general, people aren't used to these long bear markets where earnings aren't going up. So there's going to be this real struggle to say, okay, well, how do we justify a rally or a long rally in the stock market when earnings growth is zero or negative for multiple years? And the answer is you can't really, right? It means generally prices have to go down aside from the occasional bounce. So then where does money go? And you say, okay, well, gold, maybe Bitcoin eventually, but gold is really going to be that safety hedge in a market where we're probably going to see elevated inflation. So 3-4% inflation, but the Fed won't be raising rates because we're going to be in a recession. And then at the same time, the Fed really tied and unable to get us out of that recession. And then lastly, I think one of the most underrated points about gold is that everyone has hated on it, right? So it's one of the most underinvested assets out there. So if you just get it to be brought back to where it was maybe 5-10 years ago in terms of investments, you're probably easily north of the all-time high on gold at this point. So I think all those things play into it.
So Gareth, when we see, let's say the start of a move like this, do you think that there is any indication that we say from silver, for example, that silver starts to lead that move into a more sustained bull market or move up for the metals prices?
Yeah, I do. I think, even though silver is somewhat of an industrial metal, which would suffer obviously in a recession period, I still think that the value of silver will increase in a elevated inflationary environment. And if I show my chart here on silver, what's really interesting about silver is you have this resistance level that you're kind of bubbling up into. But once you take that out, you really have full range to retest the recent highs here around $30. And what I love showing to people is that when you break key levels, if you go back on the chart, you have these huge mega spikes in silver where it's almost like a short squeeze in silver. And I do think that that's probably one of the things that we're coming up to in terms of that type of spike. So I think, again, what's amazing here is it's almost like a double top here on silver, right? And again, I could easily see us, maybe not in 2023, but in the next 3 years, breaking out of this consolidation phase and then actually having one of those super spikes towards the $50 level per ounce on silver. So it's exciting to see these things because the metals have been kind of like, they like no one, if you talk to like any 20-year-old who's investing, it's either crypto or, GameStop or all these, and they're forgetting about this asset class. And in an environment where you have this elevated inflation, Fed not raising rates, a dollar that's probably declining, this is the perfect recipe for one of these super spikes.
Gareth, I want to get some of your input on how you, let's say, trade gold. Do you trade gold and silver futures? Do you like the miners like GDX or GDXJ? How do you think is your favored way to have volume, liquidity? What are you looking for in those trades?
Yeah. So for me, there's two sides to it, right? So I have my emergency stash, which is physical gold and silver. And again, it's not a lot. I don't hold a lot because, it's more meant if I wake up tomorrow and the internet's down and the banks are closed and like I have no cash on me and my credit cards don't work. Well, how do I, pay for things? How do I do what I have to do? And the answer is physical metals would then take that place, right? Either that or the barter system. So that's a small percentage. Aside from that, I mostly trade in and out of the GLD, GDX, the SLV. So I'm using the ETFs to really trade it. I don't do the futures quite as much. But again, those ETFs are really my main swing trading opportunity.
Mm-hmm. So if you wouldn't mind, Gareth, do you think we could look at let's say the GDX and get your, let's say, trend line analysis or how you're looking at it set up for this year ahead?
Yeah, absolutely. So here on the GDX, and again, this is your monthly chart, but the monthly chart's nice because you actually see that consolidation pattern, right? Mm-hmm. You can almost have these two parallel trend lines that mark the highs and the lows. And notice how we were just down here and we started to move up. And now when you have this move from the low of 2020 straight up, this now becomes what we would refer to as a in spirit of bull flag. Now, it's the monthly chart, so it's going to take some time, right? If we go to the daily chart and I zoom out, you can kind of see that in a different light. But basically, you have to come up and test this high end here on the GDX, which is just underneath $40. But that would be your breakout where you would get a big move to the upside. All right, so again, we have the bullish pattern on the longer time frame. Then you look at a couple things so the miners underperformed pretty dramatically gold this year because their inflation input costs were soaring and gold was not going up, right? So, I mean, think about that. Imagine you're mining gold. It's stuck at around, let's say 1,700, 1,750 was the average price in 2022, but all their costs were going up. Their equipment cost more. They had to pay their people more. So it really put a lot of pressure on the miners in 2022. Now, the key is going to be this. If I'm right and the inflation pressures come down to, let's say, 3%, but just stay there, but gold starts going up 10, 15, 20%, now the gold miners are in an unbelievably sweet spot and they should actually outperform. So I think the chart is kind of telling us that something like that is on the horizon. It still may be months away, but it certainly is interesting to kind of note how we're getting to that period.
Mm-hmm. And maybe we could contrast that with, let's say, the SIL ETF as well. We see way more volatility from the price of silver, and when it moves, it really tends to move. So do we see that same behavior for something like the silver miners?
Yeah. So let me take a look at let's start with the SLV really quickly, just so we can kind of check that chart out. Mm-hmm. And what you're seeing on the SLV is much the same, right? You have this channel. So same sort of channel. The only difference is silver's actually closer to the high end of that channel, which is intriguing because it means it's closer to a breakout, right? So it still hasn't broken out, but it's close to that breakout. Now, if we look at you said it was the SIL. Let's take a look at that. The standards. Global silver. Here we go. There we go. So if we look at the silver ETF, the global silver ETF, the first thing that I see on this chart is basically this downsloping trend line, right? So we put a trend line there and you can see you're still below that, but it looks to me like, again, you're kind of in that same parallel consolidation phase. And you can see that compared to silver, the silver miners have been hit much harder since this high over here. So again, I would look at this and I say, again, same kind of thing is that the silver miners may do better than silver itself, even though silver could arguably be the safer play versus the miners, right? The miners are always more volatile. So if you're going to play something, you have to be realistic and understand the extra volatility that you're aiming for when you're dealing with the miners versus the metal itself.
Excellent, Gareth. Well, I think that's a pretty decent wrap to the year here. Is there anything, let's say, macroeconomically that you're really waiting to see play out in the coming year?
Yeah, I mean, I think for me, it's understanding that likely oil is going to go lower. I know it's stuck in the mid 70s, but if we do hit a recession and the global picture kind of gets worse too, then you're looking at oil demand dropping even in spite of what's going on with Russia and some of the other things out there. So that would be something to watch. I think gold and silver have really good 2023s. And then I think the stock market, again, 20-25% down would not shock me on the stock market. My hope again for Bitcoin is that it should bottom, according to my calculations, in the first half of 2023. Maybe sub 10,000. And then I think it starts to become a very attractive asset. That's assuming we get regulation, which after FTX, I'd be shocked if we don't have a framework within a few months of regulation.
Mm-hmm. And then, of course, just to kind of round that out, you see new all-time high in gold as well.
Yes, I think in 2023, I would be very surprised if we don't make a new all-time high on gold. It's hard to know how high it'll go. Let's watch for the breakout and see the momentum that it catches. But I would be, again, if I had to pick one thing to invest in for 2023, with taking into account risk as well as reward, gold would be that spot. I think there's very little risk in being in gold, and the upside 10-20% in 2023.
Excellent, Gareth. Well, I really appreciate you helping us get a handle on some of this volatility and craziness in the world. And I look forward to speaking with you more in the new year to see how all of these things are progressing.
Thanks so much, Tom, and happy holidays.
Happy holidays, Gareth. Thanks. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.